Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Rebecca Stevenson, Senior Journalist at BusinessDesk, and today we have on Shared Lunch Greg Smith, Head of Retail at Devon Funds, to talk about the US earnings season with a focus on the tech sector. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
We are about halfway through the US earnings season, and it has been a mixed bag of results so far, including for the tech sector. Markets, including the S&P and the NASDAQ, continue to be volatile. There are some interesting forces at play here. Greg, can you talk us through what some of those forces are?
Look, obviously, there's plenty of well-known dynamics. We've had cost of living challenged consumers. We've had borrowing costs rising up very quickly over the past 18 months. We've got uncertainty about how the economy is going to play out, and obviously added to things more recently has been another war front, if you like. So this is all playing into things. And I think, as usual, obviously there's been a lot of interest in the numbers on a backward-looking basis, but even more interest, arguably, in the outlook statements. And often companies that have presented good numbers in terms of earnings and revenue beats have potentially been sort of shunned if they've delivered a less convincing outlook.
Now, you did touch on some of those geopolitical issues. Of course, we are seeing a situation in the Middle East which is creating some nervousness. We've seen some economists saying there could be some market contagion from that. What do you expect that impact will be?
Well, I think a good guide is actually commodity prices. So on one hand, we've seen the gold price, which is viewed as a safe haven in troubled geopolitical times, if you like. So we've seen gold go back above US $2,000 an ounce. And we also saw oil increase quite markedly on the initial days of the invasion. We saw crude go up to around about $95 a barrel, but the oil price has actually settled back a bit since. And obviously, a major oil producing region, we've got the oil price back at around about $88, and this also, of course, feeds into the inflation narrative. So I think the oil price is telling us at the moment that we're not going to see that regional contagion, if you like, that I suppose many are worried about. There's been conflicts for decades in this area, but more the concern, I think, from an investor's point of view is whether this spills over to Saudi Arabia and the like, and whether Iran gets involved. And to date, we haven't seen that. That's not saying it couldn't happen, but I think the commodities market and the oil market in particular is telling us it's a very localized, albeit disturbing event.
Yeah, and in terms of, the US, and I guess almost the flip side of stock markets, what are we seeing with bond yields? What are we seeing with US treasuries?
Yeah, so I suppose that the increase in interest rates that we've seen over the past 18 months or so has been coincident with volatility that we've seen in the stock market. And in particular in recent months, so you're looking at the S&P 500 and the NASDAQ have both entered correction territory. So they've fallen around about over 10% from their July highs. And a lot of that has had to do with what bond yields have been doing. And these have been pushing higher, both at the short end as central banks have raised interest rates, but also at the longer dated end. And we actually saw the US 10-year Treasury go above 5% for the first time in 16 years. And that then saw a sell-off ensue and volatility in markets. Now that's settled back down below 5%. And when we see that happen, we tend to see strength in equity markets as well. So I guess the key is, our rates are elevated, but do we go much further? And when do we start talking about rate cuts? And this is where I suppose the central banks step in. There's a lot of interest in whenever the main central banks meet, of course, the Federal Reserve, the ECB. There is this mantra of rates being higher for longer. But I think what you're also seeing is major central banks start to acknowledge that the risks are dual-sided. They still want to stamp out inflation, but they also don't want to sink the economy. And I think this has been creeping into recent rhetoric from Fed officials, but also the minutes. And you saw as well, if you look at Europe, Europe's had a major, obviously, inflation problem for some time. That's getting under control, and the ECB recently went on hold after 10 consecutive rate hikes. So, hopefully that gives investors some confidence on the equity market side that that rate tightening process may almost be done with. And we could even be talking about cuts next year. Now, the other part of that puzzle was what happens to the economy. And today, we have seen, we look to be heading for a softish economic landing, which I think would be a good scenario for the equity market.
And we've seen that really strong consumer confidence has sort of been bubbling along and keeping things ticking along quite nicely. Now, if we could talk about tech stocks and maybe look backwards to start at 2022, which was quite a torrid year. It was called the tech wreck. Can you talk us through what happened? What was the tech wreck and why did it occur?
I think, that the tech wreck, it wasn't sort of something quite on the scale of 2000. But what we did see, we saw growth stocks or technology stocks do very, very well when interest rates were ultra low, valuing sort of cash flows many years forward versus today. There's very little difference when interest rates are low. Now, when interest rates start creeping up, that increases the discount rate of those cash flows. That then follows on to the valuation of these companies, and that's basically what they reacted to. Now, a good barometer, I suppose, of how technology stocks went over the past year or so has been the NASDAQ composite. So it got down to 10,321 at a low in October, and then it rebounded through the start of this year, and it got to 14,000 in July. So that's a marked recovery. And it's since headed back down, as we've seen those bond yields that I mentioned pick back up. But if you put things in context, the NASDAQ composite is still around about 20% above last year's corrective lows. So, we have seen a tech wreck of sorts, I suppose, last year. We've seen a recovery through the initial phases of 2023. We've seen the market give back some of that since, but we're still well above those lows from last year.
And can you talk a little bit, I guess, about the S&P, because there's obviously big impact with the tech stocks in there, and particularly the so-called Magnificent Seven. Can you talk us through a little bit about, what are the impact of those 7 stocks and who are they? What's the import of them?
So when we're talking about the Magnificent Seven, we are really talking about 7 tech titans. So we've got Tesla, we've got Meta, which is the owner of Facebook, we've got Alphabet, which is the owner of Google, we've got Apple, we've got Amazon, we've got the AI titan in NVIDIA, and we've got Microsoft. And these stocks are very deeply owned and have a significant impact on the fortunes of the broader S&P 500. And if you look at, they actually account for around about 30% of the market value of the S&P 500. And also, it probably doesn't surprise as well that the gains the market has seen this year have been dominated by the Magnificent Seven. You've had the AI thematic, but you've also had others at work. Also, when you look at growth prospects, the broader growth prospects of the S&P 500, which obviously includes lots of older economy stocks as well, is much more mature. So for the current quarter, we're looking at earnings growth forecasts of around about 2%. Now that's excluding the Magnificent Seven. Now if you look at the Magnificent Seven on its own, the earnings per share growth forecast is around about 32%. You've seen big moves in lots of the Magnificent Seven this year. I've mentioned NVIDIA. They've been a poster child for the AI thematic. Their shares have roughly tripled, but you've also got had very strong performance in Meta as well. That's more than doubled. And most of the other, in fact, all the other Magnificent Seven are up 30% plus year to date, and you look at that versus the S&P 500, which is up around 10%. Now this is not coming without some cost, and investors will obviously know the concept of valuations, and even a basic one like PE gives you a bit of an idea. So the Magnificent Seven, and you got stocks like NVIDIA, which are valued at over 100 times earnings, but On average, that collective are valued at around about 28 times earnings. Now, you look at that compared to the S&P 500, if you take the Magnificent Seven out, it's around about 16 times. So there's growth there, but you are paying up for it. And so they're not without risk. So, yeah, for the moment, they're called the Magnificent Seven. Time will tell if down the track they're called the Maleficent Seven, but we'll see as the passage of time goes.
Can we do a little bit of a deep dive into Microsoft? It has really been riding high. And what are some of the factors that you're seeing at play with Microsoft?
Yeah, I think it's been interesting with the results that we've seen from the members of the Magnificent Seven already. So, yeah, you look at Microsoft, they were pretty upbeat about the outlook. And that was very much in contrast to Alphabet and also Facebook. So a lot of focus on how these companies' cloud businesses are doing, and that's all interrelated to AI. And yeah, it was very upbeat in the case of Microsoft. So, and investors are also buoyed by the rollout of their own AI product, which is Copilot. So, look, they were sending the right messages. Microsoft actually as a stock has lagged, not surprisingly, the likes of Nvidia. And it probably is seen as perhaps one of the more boring elements of that collective. But yeah, obviously a great company, has been around for a long time, and you wouldn't sort of bet against the company being up there in terms of being able to make the most of the AI thematic.
Yeah, speaking of AI, let's talk a little bit about Google, or Alphabet, its parent company. It did disappoint the market a little bit with its cloud services revenue, and it has some other things going on, like an antitrust case. How do you see the next 12 months playing out for Alphabet and Google?
Look, I think the interesting thing about that was that Alphabet actually beat on the top and bottom lines. And yeah, the other point about it, everyone will know Google and as a key part of the advertising sector. It actually did very well. It reported revenue growth of around about 11%. Advertising, a lot of investors have been worried about that market, which is correlated with, I suppose, how businesses are feeling in terms of confidence. It actually did really well. But it was more about the cloud unit. So the miss there was what investors sort of really focused on. There is this antitrust case going on in the background, and basically up before sort of lawmakers trying to prove that it hasn't exerted its dominance in the search engine business. But overall, it was a pretty good result. But yeah, focus on the cloud and focus on perhaps not getting as much market share. When you look at some of the other tech titans, it has lagged a bit there. But overall, I think it was quite a good barometer. If you're looking for, we look at these tech titans in terms of bellwethers for the economy. I thought that was quite positive in that regard. But yeah, there was very much a focus on the cloud business. And these businesses, we talked about the valuations across these tech titans. And the cloud businesses have underpinned a lot of the growth prospects over the past 12 months or so. And looking forward, if these aren't maintained, then that's potentially when you're going to get a problem in terms of the share price reaction. So, we see most of these companies beat on the top and bottom lines, but where they've shown perhaps a few cracks in terms of the outlook, that's when they've been harshly treated.
Yeah, it's interesting, isn't it? And, another business that has really exposed or really gone hard into cloud, I guess, is Amazon. Now it had what I'm calling a beast of a result. What could perhaps slow Amazon down, and what do you see as being some positive things coming for Amazon?
Well, I think, in contrast to Alphabet, you did have the similar story of the advertising side rebounding, but you also saw that that rebound was being captured more by Amazon than Alphabet. So you look at revenues there; they're up 26% at Amazon, so they're more than double the growth that Google saw, and also ahead of Facebook, so not by much, sort of around about 23%. So yeah, they're really going to benefit from the advertising market turning around. Yeah, Amazon is a huge barometer for economic activity as well. And they actually upgraded the outlook. So we're talking here about companies being rewarded where they have a positive outlook. They expect the key holiday quarter We're going into that over the next sort of few months to be very solid and to see around about 160 to 167 billion in terms of sales, and that would be up around about 10% on a year ago. So that went down really well. It's just worth pointing out that we're talking a bit about the top line here, but these companies are having to work on the bottom line as well. And particularly given they are pandemic beneficiaries, obviously that was a very unusual, abnormal environment to be in, and things have obviously settled down since, thankfully. Amazon was really a poster child for that boom that was seen during the pandemic, so much so that they actually doubled their workforce to 1.6 million people globally. Now they're right-sizing that. They are laying off some staff. I think that's around about sort of 27,000 or so this year. But in context of how much they grew it, they're still actually one of the biggest private employers globally. So these tech titans, we're looking for growth at the top line, but we're also seeing them to recalibrate if they need to in terms of the expense line, which will obviously help earnings.
In terms of Meta, it does also have a lawsuit, a little bit like Google, except this one, it's got, 41 states leveraging some pretty serious allegations against Meta. How do you see that impacting the stock? And is it something that investors should be keeping an eye on?
Yeah, I mean, I suppose the dominance these companies have achieved, not just in the stock market, but just in life generally, it's not surprising it's increasingly attracted the ire of regulators. I mean, we're not going to see, I don't think we're going to see any of these companies forced to break up. It doesn't really seem like that's going to be palatable to the companies, to the industry, and it's probably not going to work. It's interesting, you could sort of bring it back to what we saw during the GFC. It was all about the financial institutions that were in focus, all about the banks, the calls for them being broken up and the like, and that never really happened, and there were never really any fines of substance handed down. So you could say sort of history's repeating a little bit. I think most of these big tech companies will navigate the actions that are being thrown at them. They'll do their time in court or in front of lawmakers. They'll pay their fines. They'll probably make some concessions along the way. But ultimately they're going to continue to have some pretty powerful dominance. And these obviously are all multinational companies. That's probably the other issue as well, that each of these actions being taken are by respective sort of local governments or regulators. So unless they can also band together as well, it's probably still going to be a win-win for a lot of these titans in terms of any major regulatory action.
Now, talking about, some of the other really big players, we really can't not talk about the streaming stocks, and how they're performing. They're also heavily intertwined in our lives. What should we be aware of there?
Well, it's interesting. So we've had, I suppose what we're seeing now is streamflation. So the streaming stocks, you think of Netflix and Spotify is the one that's reported recently, have been very slow to actually put up prices. It's been a very competitive landscape. But and there was a lot of concern about what would happen when Netflix has done that. And a lot of the companies are also constructing different tiers as well. So you have one where you pay for ads, one where it's ad-free. And the numbers from Netflix are really strong. People are happy to sort of pay the extra couple of dollars a month and also sort of do without ads. And it was a similar story for Spotify, and they've announced plans to sort of put up their monthly plans as well. So I think it was just a good reminder that streamflation is well and truly here. What's also interesting though is that we've had cost of living pressures. There's been some concern that that these companies might suffer, but obviously when you're paying $20 or $30 a month, paying an extra $1 or $2 is not seeing people cut the cord. In fact, they're probably looking at ways to sort of cut their expenditures elsewhere, which sort of make some more sort of meaningful impact. So there was a lot of concern initially about the advent of all this competition in the streaming market, and Netflix shares were under pressure last year, but it seems that there is appetite for their services and at a higher price point. And there's also reports actually as well that Apple is also looking to put up its prices.
It's interesting, isn't it? Because I think consumers, we're getting used to sort of bouncing around from stream platform to stream platform. And so you might lose us for a while, but we'll be back.
That's right.
If we can look ahead, some really interesting stocks yet to come. Obviously, Apple, who you've just mentioned, who is just a huge player to keep an eye on. And then in the following weeks, we've got Uber, the retail results start to come in, and then Nvidia. What are you picking is likely to transpire?
Well, look, the interesting one for Apple was a pretty quiet quarter last time around, and I think there'll be a lot of interest in how they see demand shaping up for the new products that they've launched, obviously with the new iPhones as well as other products, and that's ahead of the key holiday quarter, which is the current one. Also, China will be in focus. There's been obviously much made of the fact that China is there's a bit of a backlash going on, I suppose, tit for tat versus US companies, and China's been encouraging central and local government employees not to use iPhones. We've also had an action. A notice recently served on Foxconn, which is actually effectively a Taiwanese company, but based in China and is a key supplier for Apple. So it'd be interesting to see what it makes of all that. And of course, Apple is a key economic bellwether as well. We've seen a lot over this earnings season about companies doing well where consumers are trading down. The appetite of Apple and the ecosystem that it operates has been very strong, regardless of when the consumer's been pressurised. But, they have been putting up prices. They do have, pricing strength. So it'd be interesting to see whether they see any impact there. If you look at Nvidia, a lot obviously has been made of the growth that's coming and has been coming in AI. Now, they did exceed estimates at the last quarter for this current quarter is going to be reported on. So it'll be key to make sure that they are achieved, if not bettered. Also, last time they didn't, they sort of played down the export ban being proposed by the Biden administration. So again, do they still sort of hold that view? But obviously, that stock's had a tremendous run this year. It is off its highs, but I think given what's been priced into that stock, the outlook will be pretty key there.
And what do you expect to see with Uber reporting?
So look, again, another company that's been has had a pretty sort of tasty valuation. The competition sort of creeping into the space as well. Again, it's a barometer of economic activity. Ride sharing, I suppose, has obviously been very strong since the end of COVID. Has it continued? You would have to think they're still probably gaining a little bit of share, but key will be how they sort of see levels of profitability over the next sort of few years.
And are there any other US stocks that you're keeping your eye on and that you think Sharesies investors should be watching too?
Yeah, look, well, obviously a big one is Tesla, and they've already reported, of course, but there was not a positive reaction to that stock. So they delivered their first quarterly earnings and revenue miss since 2019, and it was interesting listening to the earnings calls. I'm sure many of Sharesies clients have done so, but Elon Musk was very apologetic about things. He's obviously worried about the economy, but I think the key part of the reaction to that result was that the Tesla's been cutting prices, and that's well documented, but the impact has been more severe than expected. And if you look at the average price of a Tesla model, it's down around about 20% on a year ago. And when your top line's going down, you've obviously got to make improvements at the bottom line. And I think obviously that's what the challenge for Tesla. In fact, Musk said on the call that trying to get the cost of a component to make a Tesla down was something to akin to digging a tunnel with a spoon. I think it was also a bit of disappointment. We've talked a bit about Outlook today, that there was no definitive timelines for the Cybertruck, for the robotaxi ready vehicle. So I think that was just interesting, backward looking at a result. I think in terms of forward looking, it's going to be interesting to sort of see how the discount retailers shape up. So we've got Walmart, we've got Target, we've got Home Depot and the like. They're a really good read on how the consumer in the world's largest economy is faring. As mentioned, we've seen a lot of trading down by consumers, so they're still spending, but they're being choosy and they're trading down to lower priced alternatives in some occasions. This is already benefiting lots of, I suppose, well-branded companies with pricing power. And you think about recent results, Coca-Cola doing very well, put up prices by around about 9%. That's around about what it sort of grew sales during the quarter. It's not sort of seen any reaction there. Actually, by the way, it's also not really seen much reaction in terms of all the hype over obesity drugs. Another that's doing well, and if you look at sort of the discounted end of the chain, talked about Uber before, but also McDonald's. They came for great results. So again, they're not sort of seeing any reaction to those sort of weight loss drugs sort of drive, but also they've been putting up prices as well, and there's been little reaction from consumers other than to trade down. Although there was one interesting point from that cause that they noted middle class customers were actually, I suppose, they were benefiting because people were sort of maybe not going out as much to that fancy restaurant, but going to a McDonald's more, so they were benefiting there. But their lower income earner customers were a bit more challenged. So I think that's something to watch, and I think that's something to watch with the results from these three big US retailers in a couple of weeks' time.
So we're going to save on our Maccas and put our pennies aside for our Cybertruck. That's what I am taking away from that one. And speaking of Elon as well, he's always involved in crypto and talking about crypto. What are you seeing in terms of crypto? Is it inching its way back?
Well, it's up around about sort of 30% over the past month. So I think you'd have to say that that crypto has come back. So around about sort of just under 35,000 at the moment. Look, it's interesting. It's coincided with obviously the developments in the Middle East. You have seen it, like gold, see some appetite on the back of that safe haven appeal. Crypto obviously has been hugely volatile. It's a safe haven, but if you look at how it's tracked against gold, it's been a lot more variable. And then obviously you dig down. Literally, there's obviously lots of different, thousands of different versions of crypto. Obviously, everyone, I suppose, refers to Bitcoin. Yeah, perhaps it has its place in a diversified portfolio. I suppose there's lots of unknowns with respect to crypto. We've got obviously increasing regulation. There's always chance of failures. We've got a certain trial which has been going on recently that obviously has captivated a lot of attention. There does seem to be a bit of a move towards it in terms of being accepted mainstream, from where it was a few years ago. But that will probably also naturally mean greater regulation, which is probably a good thing. But in terms of a white knuckle ride, I'm sure Bitcoin and other cryptos will provide that for some time.
So just to recap, what is one key takeaway from today's episode that you think investors need to know?
Well, I think it just sort of, summing up, obviously we've seen a very interesting year, to say the least. We saw markets, power high early in the year. We've seen a correction in the last few months. We've seen lots of dynamics, which we've talked about. But ultimately, a couple of big things. We're seeing inflation come down. We're potentially seeing interest rates, as high as they're going to go or not far from it. And we've seen economies navigate all this without a hard landing. It looks like we might get through this all with a soft landing. We've talked about the world's largest economy today. I think that's provided some good signs. I think the earnings season is providing some good signs. We've got a lot of companies that are well below their highs from earlier in the year. And I think, as we head towards that sort of seasonal period when investors start sort of introspecting their portfolios and perhaps a lot more optimism creeps in, it could be a good time to increase exposure to some of the names we've talked about. Historically, the December quarter, or the last 3 months of the year, is a positive one, and particularly when we've seen a bit of weakness in the sort of the preceding 3 months, and I think we've certainly seen that. So, it's been a bit of a roller coaster ride this year, but I think there's good reason to believe that the fourth quarter will end much more positively.
Thanks, Greg, and thanks everybody for tuning in. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a 5-star rating and a comment on who and what you would like to hear about. Business Desk is offering Sharesies investors free access to its business news service from now until November 30, 2023. To start reading breaking news, analysis, and commentary on a wide range of topics for free, follow the link in our description. You need to be a new Business Desk subscriber and use the link provided to take up this offer. From December, you can continue at a discounted annual rate and receive a full complimentary subscription to the Wall Street Journal. Enjoy the rest of your week.